Welcome to Dementia Friendly Prince George's County, Maryland Northern Sector webinar series for caregivers. Today's topic is Long-Term Care Planning by Mark Gottlieb. Sponsored by Prince George's County Government and the Department of Family Services.
I have many years of insurance experience, much of it focused on what I refer to as the mature market, such as things through long-term care, Medicare, life insurance, final expense, and annuities. I've been on the other side of the fence in terms of being a health services professional, so I feel like I understand the long-term care system pretty well. I represent multiple insurance companies, which allows me to provide insight and input about differences in prices and coverage, and also do a lot of speaking in different venues, both by webinar and in person. So we'll jump right into the subject of long-term care. So the very first and most important issue is always, what is the need for care? Am I going to need care? No one would like to think they're going to need care, but frankly, 70% of those 65 plus, at least according to professional literature, will need some level of care at some point in their lives. Of that, typically we talk about 80% being informal care. So out of 100 people, 80% of them may be receiving care from family members, community members, etc. 20% typically receiving through formal care. When I say formal, that means care that you pay for. So we'll be getting into that. What are the issues with people looking into long-term care insurance or planning for long-term care? Denial is number one. No one really wants to believe they're the one that's going to need care. People will often say, well, I'm pretty well. Why do I have to worry about needing care? Well, obviously things happen along the way, and we also age. As we age, we become a little more frail. We may have the onset of a number of conditions. Lack of understanding. A lot of people just don't understand long-term care insurance, or they've had some explanation from some people that they didn't really understand, didn't trust, and so, they just never pursued it. Also, again, what is our need for care going to be? What are the types and levels of care we're going to need? Hard to plan for. Am I going to need 2 hours of care a day for 6 months? Am I going to need 12 hours of care for 5 years, etc.? So, when we're doing planning and financial planning to try to protect ourselves, we just don't know. So this is something that, one has to face when doing a plan for the long term and figuring out, how am I going to be able to pay for care should I need it? Number of other issues associated with long-term care. Certainly there are family issues, and this is kind of an outline of what we're going to discuss. I'll be getting into more detail about each of these topics as we proceed. But the need for long-term care certainly has impacts on the family. There are a lot of community resources out there for long-term care. It's not like the good old days, or maybe bad old days, when all we thought about with long-term care was a nursing facility, which of course no one wanted to talk about that. There's a whole long-term care system in place now, which is actually great, as people enter the need for care. The costs of long-term care we'll get into, but I can emphasize right up front, Medicare does not pay for long-term care. It'll pay for the first 100 days, pretty much, and that's it. And that's not even really considered long-term. So there's a great misconception, at least according to literature and surveys, they seem to indicate that at least 50% of people, when asked, think that Medicare is going to pay for their long-term care. Unfortunately, not the situation. So what are the resources to pay, given that Medicare does not pay for long-term care? And then the resources, in fact, the long-term care insurance and other funding options, as well as our own assets. So just a few facts to kind of give you an overview of the subject. About 2/3 of the use of benefits are by females. That's, of course, we're talking about use of benefits, meaning for those who have a long-term care policy. About 2/3 of the claims, are by and for females. Approximately 90% of the use of services attributed to those over 65. I mean, people will typically think that when you get to be 80 and over, that's really where a lot of the population is in terms of use of long-term care. Unfortunately, there's a percent that are even under 65, and then of course some percent that are going to be 65, let's say, to 80. So you never quite know when the situation will arise, which is another difficulty in planning. Of the population of users 65 plus, if we're trying to plan how much care am I going to need, how much financial planning do I need to do to be prepared? Generally speaking, again, literature will say of that 100% of users that need care, 40% will need 2 years or less. 40% need 2 to 5 years of care. And unfortunately, 20% of those needing care use more than 5 years. And for some diagnoses, some conditions, people can use anywhere from 10 to 15 years of assistance. So it's a very serious issue. It is estimated that 50% of those 85 plus have some level of dementia, including Alzheimer's. I just read a report in the last few days saying they estimate that there's about 7 million cases of Alzheimer's. As much research as they keep doing, the number seems to continue to increase. So that's a real dramatic statistic. So when we get to family issues, needing long-term care provides a lot of emotional and psychological impacts, both on the person who needs the care as well as their loved ones. The desires of the person needing care should be certainly taken into account. You know, family members shouldn't say, well, this is how we're going to deal with it. This is what's most convenient for us. Convenience is a reality, but we want to make sure that we take the needs of the person into account. Big issue in this whole field is the roles and responsibilities of family members. The statistic, they range, but basically the one I'm going to use, 53 million unpaid caregivers in the United States. So, you know, a great deal of those are employed. So the challenges associated with being employed and then providing care to a loved one are significant. They're both physical and emotional in nature. You know, they take a toll on the spouse or the partner or the adult children. You know, many of the caregivers have other careers and family responsibilities. So, you know, if we don't have money to pay for care, without question, I become the caregiver. I don't have money to hire someone who can assist in the care of my loved one. So that's at the crux of the decision about, do I need long-term care insurance, or of course, what are my other assets and income that will allow me to pay for it? You're really lucky and you have a tremendous amount of assets or very large retirement incomes. You can do it without any long-term care insurance. But for many, we're in the middle income, middle asset arena. And so those assets start getting hit into, and if it's a significant condition or illness, It can present tremendous challenges. And of course, there's the geographic considerations. You can't just say my adult child is going to take care of me. That person can live, if you're talking from Greenbelt, they could live in Fort Washington. You can know how long it's going to take someone to come to your house to assist you, let alone if they're living on the other side of the country. So it's something to be considered. I mean, with this evolving geographic situation with adult children, let's say, especially, they grow up and take a job wherever, and there goes your informal caregiver. And so it goes for a spouse or a partner as well. I mean, we can always say, well, my wife will take care of me, or my other loved one will take care of me. Well, what if he or she is not capable of doing that, him or herself? It's a dilemma. We just don't know what's going to happen when the time comes. Community resources. I mentioned that the long-term care system is significantly developed at this point. So we're not just talking about a facility, a nursing home, or at this point, a lot of people will look at assisted living. Those assisted living communities are becoming more visible. It seems like more of them are springing up every year, but there's a large array of professionals that are involved in the long-term care system. They're what's called geriatric or life care managers who can help a person navigate the system. A lot of them are working for people who may not even have another loved one who can help them to go through the process of identifying what resources are available and how to place them there. There are a number of placement companies, just a few include groups called Oasis Care Patrol and A Place for Mom. They will help people make decisions about where to move to. So you're in your own home, and now you realize we really need to move to assisted living, but there are so many options out there. How do I know how to select them? A placement company can help you do that, and typically there's no charge to the person they're helping. The community or facility that the person is placed in will pay a fee, typically at least 1 month's worth of rent, if you will, to the placement company for their services. Wide range of home care agencies. There's personal care versus skilled care. Vast majority of long-term care is through personal care aides, home care aides, geriatric care aides, whatever you'd like to call them, who are helping you with the activities of daily living, bathing, dressing, grooming, toileting, etc. There is a little bit of skilled care involved, and skilled care in most cases is being paid for through Medicare, so that's a good thing. There's also a whole field that's sprung up called companion care, just people who are alone and need someone to come in and assist them basically with socialization and sometimes some other supportive services. There's elder law attorneys to help you with estate planning, Medicaid planning, setting up guardianships, powers of attorney, and wills. Insurance and financial advisors, planning to ensure needed funds. We're talking about that tonight. I am not a financial advisor. I am an insurance professional, but I certainly know enough to advise people generally how to think about, their financial planning. But a lot of people will use true financial advisors. It's also, there's a Veterans Aid and Attendance Program, which is part of the insurance process that one can be used if you're a veteran. Assisted living communities, wide array. There are a number of small group homes, 5 to 8 beds, much more personalized, typically less expensive. Then there are the larger communities you may be familiar with around the county and throughout the metropolitan area. Some big, beautiful communities lots of amenities, lots of services, entertainment, a whole array of things. Can almost be like a large hotel that's providing assistance. That's going to be more expensive, certainly. Memory care communities, memory care for people who have dementia and or Alzheimer's. Alzheimer's is a form of dementia. They will need specialized communities or facilities just to take care of them. It's a little different than just being in a regular assisted living or nursing home. These are specifically geared to people who need to be supervised because they cannot reason, they can tend to wander, etc. Hospice care can be home or facility-based. Hospice is something that one will typically receive in the last 6 to 12 months of life. So that is a form of a community service. Medicare will pay for hospice care. Then there are a whole array of other services that one has to pay for, typically out of pocket. You need durable medical equipment and supplies, technology, home modification, transportation, downsizing, and decluttering. So, that in itself is a mouthful. It's a big system, and it's good to be aware of all the different options out there. And here's the reality of the situation. I hate to be the bearer of bad news, but long-term care is expensive. Home care, 25 to 35 an hour. And I'm being told 25 definitely on the low end. Probably looking at $350 a day when people have a live-in. Adult daycare, probably the best deal in town, 75 to 125 per day. Okay, so let's average that at $100, 5 days a week. Could be 5 or 6, let's say 500, 52 weeks. We're looking at 25 grand just for adult daycare. Assisted living options, 5 to 10,000 a month. A lot of them in the middle. I'm seeing some options, certainly 65 to 75. Even then, okay, so 7,000 a month, 84,000 a year. Sorry, but it's good to do your planning. I'm glad you people signed up. Hopefully this will be helpful, maybe even an eye opener. Nursing homes, 10 to 13,000 a month. Tremendous challenge. That's why a lot of people will look to work with elder law attorneys in terms of doing Medicaid planning, so that eventually, maybe because Medicaid will pay for nursing homes, who will not pay for assisted living. Tremendous debate right now. We're hearing it every day with the new Congress, with the new president, about what are they planning to do, and is Medicaid going to be slashed? If it's slashed, a significant portion of Medicaid is not just for young people with 3 children who need medical care. At least probably 50% of the Medicaid budget is for nursing home care. If that is slashed, that's going to have significant implications for everyone at home. And then the memory care, as we talked about. So it's a significant issue when you're talking about planning to pay for long-term care. Issues considering self-insuring. Certainly a lot of people will say to me, well, I'm okay, and I don't want to pay these kind of premiums, and I'll just take it as it comes. Okay, just understand, take it as it comes. If it comes and you're one of the percent who's going to need care, be prepared to pay for it, or to have certainly some issues associated with that. What are some of the issues? How long might you need care? We don't know. That's why it's so hard to plan for long-term care coverage, and you end up trying to do something. I always say something's better than nothing. You really don't know what you're going to need or how much, but you should have something in reserve. Expectations for growth of investments, for decreases in investments, or decreases in asset value, or increases. So what's going to happen in the future. For years, we've had a great run. People are saying, well, if I invest X amount of money per year and it increases by 10 to 15% per year, and I'm 65 years old, when I'm 85 or 90, look at all that money I'm going to have. Well, do we really know what's going to be happening in the economy for the future? It's a guess right now, to be honest. And the other issue in terms of, yes, if I invest now and I'm 65, when I need care at 85 or 90, well, it's probably being unrealistic. Most people who need care are going to need it before 90. Although if you're healthy, you could be doing great into your 90s, but then all of a sudden, I think frailty will possibly set in and you will need some assistance. And what age are you expecting to need long-term care? What happens if you need it sooner? So I'm going to start putting money away to increase. Let's say the market's even good, but boom, I have an incident at age 73 or 75, not at 85 or 90. How much money have I accumulated to pay? Be aware of the post-tax money that will be available. A lot of people say, okay, I have $300,000 in an IRA or a 401k. So if I have to, I'll use that. Well, remember, that's pre-tax money. So you're going to have to pay some percentage. If you're paying 30% on that money before you can use it to pay for care, instead of having 100,000 to use for care, you may only be have 70 after that money goes somewhat towards taxes. As I mentioned, financial resource, there are a lot of options. I'm not here just to sell a long-term care policy. There's a lot to think about. The assets and income streams, what kind of situation are we in? If you're in a great situation where you could say it's all excess and, instead of having to leave it somewhere, I'll just be able to have it to pay for my care. Fabulous, if that's the case. There are things called personal care agreements. You could use some of your money to pay family or informal caregivers. By entering into a personal care agreement, you can pay them some money and that will go towards a spend down if you ever get to a point where you need to apply to Medicaid when you're ready to go to a nursing home. Plans for selling a home? If yes, could use the money from the sale to pay for assisted living, of course, or nursing home. So, people tell me, well, I'm living on my own. When I become more infirm and my house is worth $400,000 or $500,000, I'll just sell it, and then I have that money to pay my rent, my lease, whatever, in assisted living. That will take me for a certain amount of years. Great. What if someone else is living in that home with you? What if you were planning to convey that home to someone else in the family, etc.? Then that changes the situation. Or I don't want to leave my home, and that's, again, statistics will say at least 80% of people will answer surveys saying that they want to remain in their home as long as they can, even if they have some infirmity. That's why the tremendous growth in home care agencies. You want to stay in your home? Well, you're not getting the proceeds from that sale to pay for care. You might be looking at something like a reverse mortgage, which are fairly popular. There are other alternatives such as home equity loans, etc. But I know there's always a lot of advertising about reverse mortgages. They are federally regulated. There are a number of companies that offer them. Medicaid, of course, you have to be on the lower income spectrum. They do have some home care waiver programs, and of course, again, Medicaid as of now would pay for nursing home. One has to understand the situation. There are going to be spend down provisions. There's a 5-year look back period. So you can't just take your money, shove it over to someone else's account, go to the state and say, okay, I'm ready for a nursing home, please pay. they're going to do a 5-year look back. And if that money was not given more than 5 years prior, there's going to be some kind of a period by which they're going to still be charging you until you reach that 5-year period. So one has to understand that. I know a lot of, elder law attorneys, certainly I know a number of them in Prince George's County, who do this kind of planning and do these kind of presentations. It's also something called the Medicaid compliant annuity, where it works best when it's a 2-person household and you can reposition assets to a legal partner or spouse, and they will get those assets in the form of an income, monthly income distribution. So that's one way to avoid the 5-year look back. There are Veterans Administration's program for those who are vets, programs for life care settlements or life insurance cash values that might have built up over the years. And then last but certainly not least, long-term care insurance or related type of products. Considerations for buying long-term care, and I'll get to the details, some details of long-term care insurance per se in the upcoming few slides. Why would you want to buy long-term care insurance? Right at the top, security and peace of mind. You may not think you'll need it, but if you have some kind of policy in place, it's good to know it's there if you do need it. Because the next two, avoiding dependency on others, again, you look to surveys of seniors, the last thing they want to do is become dependent on others. And they also recognize the significant stress of caregiving, whether it be a spouse or partner who lives with you, or again, adult children. Caregiving situations provide a lot of stress to families. It's much nicer if you have a pool of money to help pay for some care and relieving those ongoing duties of caregiving of someone close to you. Protecting your assets or supplementing your assets. Well, I have this chunk of money set aside. I'd like to have it there for my significant other or eventually to pass along. Well, you can help protect that pile of money through having a long-term care policy, which gives you a certain amount of money and a pool of benefits for you to pay out. Choice, how and where is care received? And certainly when you have someone helping you pay for long-term care, it may allow you to be a little more independent in your decisions about the type of place and how and where care is received. And of course, you want, first and foremost, you want to be able to afford long-term care. If you need some care, you don't have resources for it, that could be a tremendous problem. And I point that out when I'm talking about buying long-term care. You do not have to buy inflation protection, and you don't have to overbuy. And I say that because a lot of people, either now or perhaps in the past, they got some quotes in terms of, well, let's see, I hear about this long-term care stuff, and they'll talk to an agent who will work up some kind of, illustration. And by the time it's all done, you're going to go, well, I can't afford that. The premium for what you're telling me I need to protect myself is too great. Forget the whole thing. One way you can, act to have some long-term care pool of money is to buy it. Depending on your age, again, as we age, it becomes more expensive. And when you throw in the inflation protection, it becomes even that much more expensive. So don't necessarily just say, I can't afford it because someone told you, well, you've got to buy inflation protection. No, you really don't have to buy it. It's nice to have, but if you don't have inflation protection, at least you've bought that baseline pool of benefits, which may be very valuable to you when you need it. So with that, we're talking about long-term care insurance, the need for assistance for 90 days or longer, triggers for accessing the benefits. You have a policy, you want it to be triggered. In other words, you want, okay, I need payment. What's going to allow the insurance company that I bought the policy from to pay me the benefits as I contracted for? And it's going to be one and or two reasons. Number one, the need for assistance in performing two or more activities of daily living. Not one, just not bathing, for instance. You hear stories, well, I bought this policy, I'm having trouble getting in and out of the bath. I called the company and said, I need you to start paying me. And they go, well, is that your only problem? Anything else? No, not really. Well, then you only have one activity of daily living for which you need assistance. Call us back when you have two or more. So there are the different types of activities for which they will count and say, okay, you're no longer able to do this independently. We will start paying from the policy. Second is the need for assistance or supervision due to a cognitive issue. Again, dementia or Alzheimer's generally covers that category of cognitive issue, having trouble reasoning, having trouble recognizing or navigating your environment. And so you now need someone to be there to assist you in those duties, to protect you, basically, to be honest. So it can be one or the other. You can have two or more activities of daily living, have no problems cognitively. This will trigger it. You can be in tremendous shape. You need no help. But because of a cognitive issue, you need assistance. So one and or the other. This is kind of a one-pager which sums up. I do presentations that are an hour just talking about insurance options. That was not the purpose of this presentation, as you can see from the list of other things that I've been discussing. So here's a one-page primer on what you need to know about long-term care. I'll say it again at the end, after this presentation. At the end, there's my email address, my phone number. Anyone is welcome to call me, ask for clarification, ask for literature, ask for input. No obligation, no fees as far as that goes. I try to be an advisor who can provide, some guidance to people who need it. So long-term care insurance is basically, I'd say, three options on that realm. Number one, traditional. That's what most people think of long-term care insurance, traditional. But there are two other types of long-term care insurance. They're a hybrid policy. Hybrid meaning it combines long-term care with something else. In this case, it combines life insurance with long-term care coverage. So, that's a great option, and I'll explain why in a second. There's also an option for purchasing an annuity that offers long-term care coverage as a rider as well. I'm going to skip this for a minute and go traditional. Two major objections: use it or lose it, or future premium increases. It's because of these objections that 2 and 3 have become so popular. So not to say that there aren't times when a traditional policy makes sense, to be sure, but use it or lose it. Okay, I started paying, $250 a month for 25 years. I pass. I guess that's 3,000 at 20 years is 60 grand. And now my son or daughter calls and says, well, Mark just passed, and he was one of the people who did not need to trigger his claim for long-term care services. We've paid 60 grand. You're going to send some of it back because he didn't use any of it. And the answer is no. So this, is a big issue with a lot of people who say, well, I'm not willing to take the chance of paying out those premiums if I don't end up needing care. So that's why we go to the hybrids. Once again, with traditional, you can have future premium increases. So I agreed to pay $250 a month for this much of a policy. And then all of a sudden I get the dreaded letter from XYZ insurance company saying, "Dear Mark, because of the following issues, not personally, but overall within the marketplace, we need to ask all of our policyholders to contribute an additional percent to keep their premiums and their benefits where they are." Again, no one likes a letter saying, "Give us more money." It's understandable if you read it, but it's not something we like. So again, a lot of the markets go into the hybrid products because it's not a use it or lose it proposition. You're going to get money back, and they cannot charge any future premium increases. You use the idea of the hybrid, it's life and long-term care. So if you don't use the pool of money for long-term care, it converts into a life insurance policy, which in effect provides a death benefit. Okay, so these are popular options. Of course, typically you will pay more because the insurance company knows that they're going to end up paying something out. When they're pricing traditional, they're using their tables and their mortality statistics and figuring out, well, X% are not going to end up collecting. So of everything we've collected, we'll be able to pay out the number of claims that there are. So that's how that works. With hybrid, they know I'm paying Mark, whatever that face value is in most cases of the life insurance, even if he doesn't lose long-term care. So it's understandable they have to charge more, knowing they're going to be paying out on every policy. So when you're looking at traditional, and some of these characteristics are the same when you're looking at the long-term care riders and these other hybrid policies, they're going to look at your age, your health status. You have any conditions? What are they? Do you qualify for a policy to begin with? How much of a benefit are you looking? The more you want them to pay and benefit, the more the premium. Benefit length, as we say. Length is measured in days of care. And there's riders. One example, shared care for two people, a spousal unit or a legal partnership. Shared care. So each of us buys $100,000 of coverage, but because we bought a shared care rider, either of us has access to the full $200,000 of benefit. Also, something called elimination or waiting periods. This confuses a lot of people, especially those who bought a while ago and forgot about it. So you call and say, "Okay, I need to trigger my policy. I have this issue." And they go, "Okay, let's look at your policy. Oh, there's a 90-day waiting or elimination period." What does that mean? That means the first 90 days you pay out of pocket. On day 91, your policy will be triggered and we will begin paying the benefit. So people have to understand that. I'll bring this back up on my last slide, talking about for those who already have a policy. So again, there are a number of different policies. Now, true long-term care riders differ from a policy with a chronic illness rider. So one should be careful. There are chronic illness or accelerated death benefit riders. In some cases, they may not pay it. It's not the same schedule of benefits. Their contingencies about how much of that face value they will pay may be based on a whole number of factors. It's not as straightforward as a long-term care rider. So again, if someone tells you, "Hey, you want some long-term care, here's a nice policy," and it shows that benefits for care will come through a chronic illness or accelerated death benefit rider, not a true long-term care rider. Be careful about how they're calculating the amount of money they will pay out for that chronic illness or accelerated death benefit. There are a lot of different methods of payment depending on the type of hybrid that you take. Some you can even do, monthly up to annually. For hybrid, some of them will say single pay. Single pay would mean, okay, tell me how much in one fell swoop I have to pay to get this whole stream of benefits in place, including a death benefit and long-term care benefits. And you would pay one chunk, if that's how you want to do it. Some will offer up to a 15 pay, so to speak. So over a 15-year period, so you buy it at 65, you stop paying at 80. You don't specify these kinds of special time frames, and you're basically buying what they say lifetime, meaning you will pay for throughout your life until you either collect or you pass. So, there are some guidelines about non-taxable payouts. Gets a little more confusing, but if you have questions, again, you can feel free to contact me, or maybe there'll be a little time at the end to address it. So, some of the premium amounts may be deductible depending on whether you're able to itemize deductions. And again, with hybrid policies, you may be able to get the long-term care deduction for that part of the policy, which they calculated to be related to the long-term care rather than to the death benefit. Okay, so why not wait to buy? Here we are. I've been putting this off for a while. Is it too late? Well, that's a question one has to determine. I won't even talk about that, specifically, although, this kind of looks at it in a sense, but really, it's never too early to buy, let's say. A lot of people will say, well, I should have bought it 5 years ago. Or when the guy first called me about, do I want to buy a policy? Well, I'll wait. Someday, I'll have more money or I'll be more inclined to do it. Never gets less expensive. And, risks of experiencing an illness or disabling event. I can't say that enough. So many people that I talk to over the years, I'm going to do it. I'm going to do it. I just have to finish paying off for some other expense, whatever the expense may be. All of a sudden you get a call. All right, I'm ready. All right, I just want to make sure. Why are you ready to buy now? Have you seen the light? Yeah, well, we went to the doctor and I was told I have pre-Alzheimer's. Pre-onset Alzheimer's, which means you're going to get Alzheimer's, which means the insurance company will not give you a policy, even though it's pre and you're totally fine now. There is a diagnosis, and that may forego your opportunity to buy a policy. Percent of declinations are consistent with increases in age. Once in a while, you'll find someone who somehow, got it together and their health is better now than it was 5 years ago. Well, that may put them in a better situation to buy a policy, but they're also 5 years older, so it's more expensive. But typically, we begin developing conditions as we age, just the reality. So you're more likely to get declined the longer you wait. Just select disqualifiers. There's pages of disqualifiers, but these are certainly some of the main ones. If you've had a stroke plus a TIA, trans-ischemic attack, that combination will typically disqualify you. If you've only had a stroke and it wasn't, a serious one and you're functionally fine and there's nothing else since then, okay. But the TIA comes on, that's generally a warning sign. It's going to be too late to buy. If you have some functional incapacity already, no. Types of medications used. Some of the medications, they will call you a rule out. Obviously, if you have early onset or any level of dementia or Alzheimer's, no. Parkinson's at any level, no. Chronic obstructive pulmonary disease, congestive heart, multiple sclerosis, rheumatoid arthritis. So these are the big, level of disqualifiers. Everything else, for the most part, will be, a rule out, so to speak. They'll look at your history, make a decision. And again, prices of policies increase over time. So again, go back to, they have an issue which is going to cause you, okay, now I waited and okay, I've been diagnosed with prostate cancer or breast cancer. Thank God, got it early stage. But guess what? I now have prostate cancer. I cannot buy a long-term care policy. They're going to come back and tell me, come back in 2 years. And if everything looks good, you can now buy a policy. That's the good news. But I might have been considered preferred rating before that. I'm now going to be a standard rating, which adds expense to that. And I'm going to be older. So the more advanced age, the more increase in pricing again. Some of the select companies that offer these types of policies, this is an aside, I happen to work with all of these. I'm certified by all of them, but be that as it may, there are a lot of different companies which offer the big two for standalone right now: Mutual of Omaha and National Guardian Life. It's an interesting policy because it offers a third pool of money for a little bit more money, more premium than the others, which offer typically two pools of money or shared care. So something worth looking at. Hybrid life and long-term care. Hancock's been in the business a long time. But they do offer a policy without inflation, which keeps the price down. Same type of policy through Prudential. Some of the big hybrid policies are through a group called Minnesota Life, or Securian is their long-term care moniker, so to speak. Lincoln National, which is well known as a MoneyGuard policy. Nationwide, a leading provider of hybrid policies as well, and another group called One America, which has a hybrid life long-term care called Asset Care. And then really they are the leading and maybe still only company that offers the long-term care rider with an annuity. So you reposition money into an annuity, gives you that chunk of money to start paying for long-term care. If you need more, the long-term care rider kicks in. So that's kind of how an annuity with long-term care rider works. If you don't need long-term care, the annuity, which is grown in value, conveys to, whoever is going to inherit money. So, people like that. You'll get, life insurance benefits if you don't use long-term care. You'll get the growth of the annuity money, repositioned over to the beneficiary. There are a lot of carriers, again, who will have a life with chronic illness or accelerated death benefit. So again, you need to make sure you understand how they're defining. Different companies have different payouts on this rider, but it's, again, not a true long-term care rider. So just understand what it is you're dealing with. I think this may be the last slide, which is good. We're at 7:53. So for those who already own a policy, as I mentioned, I would talk about. Be aware of what your policy offers. For anyone who bought one, threw it in a drawer, get it out. There's a cover page, but then there's a whole document called an outline of coverage, which will specify all the different levels of care, the different types of home care. This is one that changes based on the company and how long you've had the policy. Some used to pay actually for, care provided by an informal caregiver, meaning someone who's not licensed or certified. So you have to know if you bought an older version of that policy and you look at the outline of coverage, it may say they'll pay for that. Other people will call and say, okay, I had my informal caregiver, provide assistance to me. She's given me a bill. I'm going to send it in to you, and I hope you're going to be paying it. And they go, well, look at your policy. Does it specify that an informal caregiver could have provided the care to you? Or does it have to be someone who is licensed or certified? The person looks at the outline of coverage and goes, oh, I guess you're not going to be paying that amount. I better tell that caregiver I will be paying, he or she that money out of my pocket. There's things called ADLs, activities of daily living, versus IADLs, instrumental activities of daily living. Cooking, shopping, cleaning, some policies may allow the caregiver to do some of these functions. Others only say, no, we're only paying for strict activities of daily living. Now, granted, it's tough to monitor the household. If you've asked your caregiver who provides ADLs to make you lunch, it would be pretty hard for that company to say, well, was any of the time spent helping you to get lunch or to go over to the grocery store down the block and pick something up. But nonetheless, there are specifications in terms of what they will pay for. We talked about elimination periods to triggers. We talked about that documentation is necessary. I didn't really talk during the presentation about the types of reimbursement, so I should mention that very quickly. There are two types of policies. Most of them are based on reimbursement. You have to provide documentation which shows who came to your house at what time. It's typically most tricky when it comes to home care. Who was the caregiver? What time did they get there? What activities did they perform? They'll fill out sheets, they'll be submitted, and eventually you'll get your reimbursement. There are some other policies, especially in the hybrids, where they may have another form of reimbursement called indemnity, where if a physician or other appropriate caregiver is able to show that, yes, you qualify for receiving long-term care based on an indemnity model, you contracted for $5,000 a month of insurance coverage, they'll send you the check every month for $5,000. No questions asked, no need to send documentation sheets for every day of service that was provided. That's certainly a nice feature to have if you can. Be aware, as your policy increased in value, you bought a certain amount of face value. What type of inflation did you include in there? What was your initial value? How many days of care did it include? A lot of people really have forgotten that. So for those who already have a policy, have had one a number of years, take a look at what you had. You might have had a pool of benefits that was $150,000, and hey, it's been a number of years, and I bought it with 5% compound inflation, and now it's worth $300,000, which boils down to a daily rate of payment. And all of a sudden, you discover this is great. I really have some great coverage. On the other hand, some people bought a long time ago. They didn't look at the fine print. They didn't want to buy inflation. They said, I'm happy to pay the $50 a month premium. I didn't want to pay the $120. But now it comes back to haunt you because you realize there was no inflation. So the $50 a day of benefit you bought is worth $50. How much is that in today's market? Probably about maybe maximum 2 hours of a home care. So be aware of what you've got. How does it cover with your plan's needs? Is it too late to add any coverage at this point? Do you have other assets and income to help counteract the fact that there's only so amount of money that you have in your pool of benefit. Last but not least, we get, for those who've had policies from private companies, if you're facing premium increases, they're going to give you a number of options. They're going to say, you've been paying $250, but we're going to ask it to increase to $295 a month for all of these different reasons. However, if you choose not to pay the $295, we'll leave you at $250. But here's the problem. I bought 4 years or days of care service for that $250. They're going to say, if you want to keep paying $250, we're going to take that 4 years of coverage down to 3 years. Sorry, but that's just how these policies work. Daily benefit, they may decrease the daily benefit if you don't agree to pay the increase in the premium that they're asking. So typically, to be honest, if you keep your premium at the same amount, you do not agree to have them increase it, you're going to lose some benefit. That's all there is to it. You have to do a calculation and figure out, how much am I saving by not paying the additional premium? How much am I losing? In most cases, you're certainly losing more than what you're saving. The one type of change that a person can make, if you've had your policy for a certain number of years, they might say, well, again, we won't increase your premium. You've currently been getting 5% compound. We'll take it down to 5% simple or 3% compound. There are different ways of calculating inflation. At that point, your policy might have increased to a nice chunk of money. You're saying, I'm willing to give up, a little more growth as we go along so I don't have to pay additional premium. So there are a number of things to think about. So that's my presentation. We did pretty well on a 801. As I mentioned, we have my email address, my phone number. I have a lot of information about the whole field of long-term care, and I'm happy to share that with anyone who would like to reach out to me. And again, no fees, no obligation. Frankly, when I sell something to anyone, the only way I get paid is through commission, not through any charge to any client. So I'm happy to be of service.